Part 3, Chapter 13, the Statement of Cash Flows. This is a bigger example than Joe's repair service. This is the Computer Services Company. It is an established company. They start on page 5 of your course pack handout with the income statement, and then the balance sheet, and then page 7 shows a blank or somewhat blank worksheet. And I'd like you to follow along and fill out this worksheet as we go through this presentation. So let's look at the balance sheet first. For you, that's all on one page. For me, I've got the assets on this first slide and then the liabilities and stockholders' equity on the second slide. You can see that we've got a $22,000 increase in cash for the current year as compared to the prior year. And I've got the liabilities on a second slide, and we've got increases and decreases. I've also got the income statement as do you, and sales revenues were $507,000 with net income $145,000. At the bottom of your income statement, you have the additional information, and I've got that here on a separate slide. I'd like you to take a minute with this additional information, and let's categorize it as operations, investing, or financing. And on page 5, just to the side of that additional information, I'd like you to put an O, an I, or an F. An O for operations, an I for investing, and an F for financing. The company declared and paid a cash dividend of $29,000. Where does cash dividends go? That would be financing. There's also a fourth category, and that would be non-cash. Let's look at number 2. The company obtained land through the issuance of $110,000 of long-term bonds. Now, normally land would be investing and bonds would be financing. But since this is non-cash at this time, you will put non-cash alongside number 2. By the way, there will be cash involved in this transaction as the company pays interest and when the company pays off this bond. But at this point in time, there is no cash involved, and that's why we call it non-cash. An office building costing $120,000 was purchased for cash. Equipment costing $25,000 was also purchased for cash. Well, these are definitely cash transactions because they've told you that. Where do building and equipment go on the balance sheet? Are they current assets or long-term assets? Building and equipment are long-term assets, so therefore they will be in the investing section of the cash flow. The company sold equipment with a book value of $7,000. Again, we're dealing with equipment, and you're going to put an investment alongside there. I'd also like you to add an O because there's a piece of this information that will be reported in the operations section. So we've got the sale of equipment, we've got cost less accumulated depreciation, we've got cash. We're going to come back to number 4. The company issued common stock for $20,000 in cash. Common stock is under what section of the cash flow? That would be financing. And finally, depreciation expense was $6,000 for the building and $3,000 for the equipment. And you may not know the answer to this one yet, so let's just leave that open, and you're going to learn the answer in the next few slides. All right, first thing we do is we determine the net increase in cash. And you can turn to page 7 and see where it says net increase in cash. It's at the bottom of the cash flow report, toward the bottom of the cash flow report. And you can put that $22,000 in there right now. And if it helps, put a little plus sign beside it to remind yourself that cash went up $22,000. You wouldn't put that plus sign for a formal report, but just for your notes today. Okay, we're going to start out the same way we did for Joe's Repair Company. We're going to list net income first, and then we're going to make adjustments. But the adjustments are a little bit more complex. In Joe's Repair Company, we only dealt with current assets and current liabilities. Before we even start with the current assets and current liabilities, we're going to look at these 3 categories and see if we have to make any adjustments for them. The first one would be add back non-cash expenses such as depreciation, amortization, or depletion. Deduct any gains, add back any losses. So let's start with that first one. Depreciation. When you buy a piece of equipment, cash goes out. However, for accrual accounting purposes, we don't count that. And we say, no, we debit equipment and we credit cash, but there's no expense involved. For cash accounting, we say, yeah, we bought a piece of equipment, that's a cash outflow. For accrual accounting, we say, we're going to take the cost of that equipment and we're going to depreciate it over the life of the asset. And on our income statement, and you can turn to your income statement right now and see that we had depreciation expense of $9,000. Depreciation and any other charges that don't require the use of cash will be added to net income on the cash flow report. Why? Because they really didn't involve cash. They involved an adjustment for accrual accounting purposes, and the cash flow is all about cash. So go ahead and write in net income on your worksheet. And actually back up a little bit, put the company name at the top of that statement. Computer Services Company, statement of cash flows for the period ending 12/31/2011. So let's log in 145,000 for net income, and then right under, I think I'm missing some lines here. Right under this, write depreciation expense. Right under adjustments to reconcile net income to net cash provided by operating activities. Go ahead and write in and indent that, because we're going to have a couple of lines here that and then we're going to want to total them. So we're taking that net income and we're saying to calculate net income we subtracted depreciation expense, but for cash flow purposes we need to reverse that because that really was a non-cash event. Okay. Flip back to your income statement again, and maybe you want to put a little check mark by that 9,000 to show that you've used it already. And at the bottom where it says additional information, number 6, I want you to put to the left an O, because in the operating section is where we deal with depreciation. So now you know the answer to number 6 on page 5. Depreciation expense was $6,000 for building and $3,000 for equipment. We adjust that in the operating section, and that's what we just did. Okay, go look up at the income statement. You also have a loss on sale of equipment. Now at the bottom of that page, I want you to write down the words equipment. And I want you to write alongside it original cost, $8,000. And underneath that, write accumulated depreciation of $1,000. Draw a line so you can show you're adding them together, and write down $7,000 for book value. Okay, so book value for this piece of equipment was $7,000. We sold it. Now underneath write sold for $4,000. Draw another line, take the difference, $3,000, and write loss of $3,000. Now you've got $8,000, $1,000, $7,000, $4,000, $3,000. You got a lot of numbers there. What of those 5 numbers involved cash? Well, equipment when it was originally purchased involved cash. Accumulated depreciation does not involve cash. Book value does not involve cash. Selling price does involve cash. And it tells you you had cash proceeds of $4,000. Okay, then underneath that you have a loss, and the loss does not involve cash. So we have to make some adjustments here. We had a loss of $3,000. You can look up on your income statement and you see that $3,000, but that $3,000 is just a calculated number. The cash of $4,000 was what you sold it for, and we're going to account for that down in the investment section. But this $3,000 has to be adjusted. because it really isn't a real cash outflow. And the cash flow report is all about outflows and inflows of real cash. So let's write in loss on sale of equipment. Any sort of losses you will be adding back. All right. Now we're ready to go to step 2, look at our current assets and our current liabilities. So let's go ahead. Let's flip to your balance sheet. Obviously, the current assets involve cash, accounts receivable, inventory, and prepaid expenses. So you could just draw a line under prepaid expenses all the way across. And we're going to take a look and analyze accounts receivable, inventory, and prepaid expenses because we have to report that net change of minus 10,000, positive 5,000, positive 4,000. We have to list those on the cash flow report and decide what sort of adjustment we need to make. Well, accounts receivable went down $10,000. What does that mean? That means we had a beginning balance of 30 and an ending balance of 20. That means the company, the customers, paid computer services a net of $10,000. They collected that money. When accounts receivable goes down, that means you collected money. So that added cash. So we're going to add that $10,000 decrease back to the cash flow report. The journal entry, if that were your only transaction all year long, you would have debited cash and credited accounts receivable. And that doesn't show up on the income statement anywhere, but we want to account for it in our cash flow. So there it is. When accounts receivable goes down, that means you collected money, you got cash. Okay, let's look at inventory. And we're working on page 6 of your course pack. Inventory increased by 5,000. So I want you to imagine a journal entry. When you buy inventory, let's pretend you bought it for cash. You would debit inventory and credit cash. So as far as the cash flow report is concerned, you spent that money and it has to be accounted for. So when we tie up money in inventory, it's a cash outflow. So we're going to deduct that decrease. In the same way, for Joe's repair company, when we had an increase in accounts receivable of 30,000, we deducted it. Here we have an increase of inventory, so we're deducting it. We spent cash on inventory. The same is true for prepaid expenses. Prepaid expenses was $1,000 a year ago, now it's $5,000. $4,000 increase. We tied up cash in prepaid expenses. That's also going to be a deduction. So there's a pattern going on here. The current assets all have the same pattern. When they are decreased, they are added to the cash flow. When they're increased, they're subtracted from the cash flow. This pattern holds for all of the current assets. It doesn't matter what current asset it is, the pattern is going to be the same. You're going to treat it the same way on the cash flow report. Okay, now we're going to look at current liabilities, and you can see you've got two of them, accounts payable and income taxes payable. Now the pattern that I just shared with you for current assets, we have a different pattern for current liabilities. So what happened in accounts payable?